Is regime change coming at the Fed, and are you ready for it? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Darius Dale, founder of 42 Macro. Hey, Darius, it's great to see you.
Maggie, I miss you. It's been such a while, and I just want to say your energy is infectious. I'm so happy to be here.
Uh,
You and I have been on such a cool journey together, and I'm just grateful. Thanks for having me back on the show.
Oh, so happy to have you back. And we were joking before we came on air. You're bringing the good vibes today. Good market day. We're in summer. We can't complain about anything today. I just want to say hi to everybody who's joining us live on Substack and YouTube. As always, drop your comments, questions in the chats, and we'll get to as many as you can. And if you are not subscribing or following me on Substack, do so, because we've got some really fun announcements coming, and we're going to drop them there first. So go ahead and head over there and do that. We'll put the links and everything in the chat so you know where to find it. So Darius, U.S. stocks rallied today. Nice looking rally. President Trump announced they have a trade deal with Japan, reportedly getting close to one with the EU. So it looks like maybe things are starting to fall in place by that August 1 deadline. Is this tariff news good news for corporate earnings?
No, it's not great for corporate earnings, but you know what is great for corporate earnings? A booming economy. And that's exactly what we're headed for. And that's exactly what we've been arguing for since April 23rd, when we authored the Paradigm C theme that, in our view, has become the theme across global Wall Street. Kind of just quickly summarizing, Paradigm C is a situation where the administration is pulling all the levers that it can, including negotiating trade deals and trying to rewire global trade in favor of American companies. They're just essentially trying to create an economic boom because they figured out that cutting your way out of the fiscal mess isn't going to work. So now they've ported ourselves over to trying to grow our way out. Newsflash, is not going to work, but there's at least a couple of years to figure that out, maybe 3 or 4 years to figure that out. And so I think you're in a tough spot as a bear here if you're trying to fight that.
Yeah, and that's the thing. We've seen that bearish, people sort of attempt to do that, and it's been tough. And you've seen this. Now, does it feel like things are getting a little over exuberant here or toppy? I mean, we have meme stocks back, Open Door, Krispy Kreme. A lot of people have been talking about the fact that they've seen huge moves there. Does it feel like sentiment's toppy, or is this what happens when you have an administration just hitting the gas and determined to make sure that we've got a strong economy?
Yeah, 100%. I mean, I think it's easy to sort of point to, okay, things look toppy, and by some metrics they do. But when we look at our positioning model, we're nowhere near where we were in February, prior to acknowledging that Paradigm C was the most likely outcome from the set of asset markets. So not only do we need to get back to where we were in February from a positioning cycle standpoint, we've been making the case that we need to go well past that, because the distribution of probable outcomes has shifted to the right. There's just more right tail risk relative to where we were in February, at the highs in February, that suggests that we have, tremendous amount of scope for upside. Is it all going to come in the next 2 weeks or 2 months? Of course not. There's going to be volatility to risk manage along the way. But if you're an investor that's focused on an on-time and comfortable retirement, or you're a buy-sider that's focused on, a lucrative bonus, ignore the chop, ignore the scarecrows, ignore the volatility, because the dip has to be bought by the legion of underperforming investors that ultimately need to capitulate into our Paradigm C theme, as many folks on Wall Street have in the last 3 months.
So Boris has a question. Hi, Boris. And saying, so cool to see you. Question for Darius. Are you also convinced that global liquidity is the main driver of markets these days?
No. It's any one of the 5 cycles that matters to asset markets can be the main driver of markets. So that's growth, it's inflation, it's monetary policy, it's fiscal policy, it's also liquidity. And any one of those times, at any given time, one of those cycles can be dominant. I'll give you an example. Back in late 2022, obviously early 2022, it was about growth and slowing to a below trend level, and inflation obviously galloping to a 40-year high. We didn't really necessarily resolve those problems, but the markets bottomed because of the global liquidity cycle inflected and really started to accelerate. So that's an example of where liquidity was dormant in the first half of 2022, all the way through the lows of 2020 of October of that year. But then it became, when the impulse is big enough, it overwhelmed. And so it's our job as investors to identify at all times where we are in those 5 cycles, and in relation to where we are in the 6th cycle that matters, which is positioning, and to see what's priced in, what's positioned for. And in our view, our Paradigm C theme is not positioned for. So ultimately, there is a durable positive shock to growth that will likely result in a doable positive shock to liquidity, because liquidity is co-integrated and correlated with growth. So you're ultimately talking about two very important tailwinds that should last for multiple years, at least into the midterm elections next year, and that's quite a ways away in x-axis and y-axis terms if you're short that.
Does this growth come with inflation?
Unlikely. I mean, we know we have tariffs, right? So we're going to see a one-off price level change to the tariff sectors of the economy, and so we're going to have to deal with that and eat that as investors. But I got to imagine a lot of that was priced in at the lows of April, April 8th, or whatever. I think we bottomed the day before April 8th. But the reality is we priced in a lot of the tariffs, and so the reality is, in our view, tariffs are kind of a non-event, and we've been making the case that since May 3rd that they're a non-event. It's not that they are not going to come and they're not going to shift the price level higher. It's just that they're one of several levers the administration is pulling to create a net positive outcome for the U.S. economy. And on a net basis, when you factor in broad-based deregulation, particularly in the financial sector, which touches every other sector of the economy, and you factor in tax cuts, the immediate expensing of capex and R&D and the qualified business deduction, you're talking about pumping hundreds of billions of dollars into the economy year after year from those perspectives, and then also accelerating the private sector credit growth, which for almost 2 years now, going on 2.5 years, we haven't really seen a real meaningful impulse from a private sector credit standpoint. And so that's a lot of positive stuff that is yet to occur, that is likely to occur, that is likely to drag both liquidity and asset markets higher over the long term.
Is this benefit to asset markets? Is it across the board? Do we see a broadening out? Does it feel like tech still leads? By the way, we've got Alphabet and Tesla reporting after the bell here as well. Does it seem like that's the story? Because for a while, the narrative is like, oh, the AI bubble's over. There's no moat. We now see that it's about efficiency. You still have a lot of people talking about it feeling like 1999 and the dot-com bust. I mean, I hear this still as I speak to people. Does it look different? Does the benefit to stocks look different, or is there some rotation? How are you seeing that play out?
Yeah, that's a great question. So, in our opinion, the benefit to stocks is yes. So the answer is yes. We have seen a broadening out. Tech is obviously still leading and has been leading since the lows, and since our market regime nowcasting process pivoted us to a risk-on market regime on May 13th. If we look at it from a sector standpoint, tech is the best performing sector at up 11% versus 7% for the SPY. But we're also seeing a tremendous amount of participation in international equities as well. If you look at emerging markets up 9%, China up 10%, commodity producers up 7%. You're seeing a lot of breadth, and most importantly, you're seeing a lot of breadth in the factors that tell you that things are fine economically. High beta doing really well, dividend compounders lagging, things like quality lagging, small caps performing in line with the market 7%. These are all things that are telling you, A, we're in a risk on market regime. This is the kind of factor leadership that you would expect. But B, it's telling you that the market internals think we're headed for positive outcomes. And this is what we've been coaching investors in the context of our Paradigm C theme we authored it on April 23rd, but we always thought from April 23rd to May 3rd, we were making the case that we were in a U-shaped economy with a W-shaped market, and expecting kind of this second leg down before we actually hit the new highs. On May 3rd, we said there will be no second leg down. And the reason we realized that there was unlikely to be a second leg down, because by then it became very clear to us that Wall Street was dramatically underpositioned for the U-shaped economy. And I would argue that this side of the U, the more positive side of the U, is much bigger and will last much longer than the negative side of the U. In our opinion, Wall Street has not fully positioned for that yet, although they have come our way over the past few months.
Yeah. Really interesting to think about that. And, we've had conversations before about just shifting your chart a little does amazing things, right? You just got to expand that right side. George is pointing out, thank you for that, George. Google is down after hours on reporting. We'll have to see if it's a fade, the initial move is George's comment. You're right. And of course, a lot depends on the conference calls as well. I think we always have to wait for that. So a little bit of action around that. George is also asking, as I mentioned his name, do you see, Darius, do you see more trade deals before August 1st, particularly interested in Canada, Mexico, and the EU? Those are the big ones.
So I have the great pleasure of being a dad to an incredible 1-year-old whose birthday was yesterday, and I've gotten to know who's my favorite TV personality right now is Elmo. And I don't know if you guys seen that Elmo GIF where he's got the shrug. It's like,
That's right.
sorry, George, I have no idea. I'm not working in the administration. I've a former client who's the Treasury Secretary, so and I don't even have a line into him. And quite frankly, if I did, one, I wouldn't be able to use it from a compliance standpoint. But two, I don't even think he knows where we're headed with all this, right? But I think we have to assume, and this is what we've been telling investors since May 3rd, is assume that the trade deals will work out on a net positive basis because the administration has already pivoted us to paradigm C. Like, we're not going back to paradigm B, in our opinion. And the reason why we're not going back to paradigm B is, I could show this in 3 or 4 charts, but I'm just going to show you one chart. This is our net international investment deficit. It's at $26 trillion. It's 90% of our GDP and a fourth of global GDP. In the first part of April, certainly throughout the first half of April, we saw several indications of actual capital outflows, which is something you never see in the U.S. markets. You tend to see capital rotation from stocks to bonds and so on and so forth, and within sectors and factors within the market. But we actually saw EM-style capital outflows in the Sell America trade manifest on several occasions. And in our opinion, we think that spooked the administration. And the reason it spooked the administration is because if we start a series of cascading capital outflows, we are ultimately going to wind up with a debt spiral. And the reason we say that is if you look at the price which we are capitalizing our stock and bond markets on a median basis, it's about 4%. In terms of our earnings yield versus on average with our 10-year nominal treasury yield. That's on par with Japan and below China and Europe, which are the 2 to 3 largest net international investment surplus economies in the world. So we're paying the same or less for equity and debt capital than the rest of the world is paying, particularly the 3 largest creditor economies are paying, which makes no fundamental sense. And so the risk of persistent Sell America trade style capital outflows, in our opinion, signaled to the administration with that pivot that we saw on April 9th that, hey, if you want to bully the world into a new trade paradigm, guess what's going to happen? You're going to wind up in a debt spiral where your cost of capital is accelerating, the dollar is going down, and you're not going to be able to print your way out of it. Or you would be forced to print your way out of it, which is obviously a lot of empires have ended historically. So I don't think we're going back to paradigm B, which insulates the downside risk in the market. I think at the time on April 10th, I said, hey, this pivot by the administration shifts the entire distribution of probable outcomes to the right. Like picking up the distribution and moving it to the right. And I think that was the appropriate call.
Yeah. Hi, Ralph. It's great to see you back in the chat, by the way. He's been a busy, hardworking man. So I wanted to get John. John said, and I want to get to monetary policy because you mentioned it before, where all of these systems are now working to make sure that we sort of grow our way into dealing with the problem. John said there's zero need for the Fed to lower rates. And with a booming stock market, with the economy looking strong, it does seem that this desire for, and sort of telegraphing coming from the White House that he wants lower rates from the Fed, it's sort of on a collision course because it doesn't seem like it's compatible. How are you thinking about the Fed and monetary policy here? Because you put out a really interesting thread on this on X.
Yeah, well, look, I have cyclical views on monetary policy, and then I have structural views on monetary policy. And we've had these structural views on monetary policy for 2 years now. Summer of 2023, we authored our Investing During a Forward-Turning Regime framework, which is an empirical deep dive on probably 50 or 60 different cycles within the economy and policy, and also from a geopolitical perspective that helped investors sort of create a very credible data-driven roadmap for what we should expect as investors living through a forward turning. And one of the key takeaways from that presentation, of which there are many, one of the key takeaways in that presentation is that, hey, forward turnings always end in fiscal dominance, and fiscal dominance requires substantial monetization of deficits and financial oppression. And historically, we've seen those types of outcomes, not just here in the U.S., but I mean, this is pretty typical whenever you get to this level of inequality in society. You tend to have populism. Populism begets fiscal dominance. Fiscal dominance demands financial oppression and deficit monetization. So that's where we're headed from a long-term perspective. And so ultimately, we are of the view and have been of the view for the past 2 years that we were going to see an increasing loss of independence by the Federal Reserve to support this fiscal dominance regime. And so, in our opinion, a lot of what we're seeing on the tape in recent months, as it relates to the Trump administration attacking Jay Powell and attacking the credibility of the institution, we think that this is just setting us up for a structural strategic play whereby the Treasury LBOs the Fed, much like it did in the previous fourth turning. Recall, the Fed was not particularly independent in the previous fourth turning. This whole concept of Fed independence and 2% inflation target, all these are things that we make up. And so guess what? We're going to make something new up to support the fiscal dominance regime, in our opinion. And so that's why over the long term, we believe monetary policy is going to get very, very loose as a function of that fiscal dominance. And so I'll leave you with one statistic on our structural views of monetary policy. The floor Fed funds rate, which is the the minimum value on the overnight index swap curve out 2 years, is currently at 310 basis points. It was a little bit close to 4%, at the start of the year. If you subtract the TIPS break even, the 2-year TIPS break even rate from that statistic, you wind up with about, let's call it 36 basis points of real floor Fed funds rate. That was at 150 basis points at the start of the year. So we've lost more. We've already cut the floor Fed funds rate on a real basis by more than 100 basis points since the start of the year. And in our opinion, this is going to go negative at some point in the next couple of years, and it's going to remain persistently negative because based on our current, debt deficit and debt and demographic dynamics, the only other choice we have is to print our way out. We're going to try to grow. If you're a sovereign that's this indebted, you have 3 choices. Cut your way out. Well, we tried that, didn't work. We almost blew up the global financial system. So now they're going to try to grow their way out. It's not going to work. I'll newsflash, but it may persist for several years. And then the next step will be print your way out. And we think they're getting a jump start on this in terms of trying to LBO the Fed into persistently negative real policy rates. So that's where we're headed, in our opinion. That's next 3 to 4 years. You got to assume that is the outcome from a Fed monetary policy standpoint. Going back to Ralph's question, I don't know that I agree that there's no reason for the Fed to cut interest rates right now. We just got the worst jobs report we've gotten in years in the month of June. And so if you the way we sort of triangulate what's happening from a labor market perspective, just from the perspective of consumer income, which is what really matters. It's not jobs that matters. It's how much income are we generating from the labor market so that we can go buy goods and services. And so when you look at employment growth, wage growth, and hours worked, and you sum product those statistics from the perspective of the private sector labor income slowed to 1.4% on a 3-month annualized basis. That's a well below trend rate. It's the lowest level we've seen since June of 2020, which we were in lockdowns from COVID. And then it was the sharpest delta, sequential delta, slowest delta rather, since May of 2022. So there's clearly something going on in the labor market that we think the Fed should respond to. Do we think we're headed to recession? Absolutely not. Again, we have this U-shaped economy thesis, but I would say we're probably somewhere like right here on the U. That gives the Fed a window to do what they probably should be doing, which is lowering the policy rate.
Are things changing to the extent that the bond market will toe the line if this is where interest rates are going? So there's this idea, right, that the Fed sets the rate, the short term, but you've got all these other people that own bonds, and bond investors may want to be compensated for taking on what they perceive to be greater risk. The old bond vigilantes, right? We haven't seen them in a long time. A lot of people thought they were dead. We thought they came back. Do you buy this idea that, okay, the Fed can do whatever it wants, but with high levels of debt, and if there is a perceived increased risk to holding U.S. assets, that bond investors around the world, because it's not just domestically, they're owned by international investors, will want more compensation for owning that? Is that a problem in that whole let's get rates lower scenario?
Maggie, that's the question of the fourth turning. And the answer to that is investors are already demanding more compensation, and they will continue to demand more compensation, especially as pockets of the market start to move away from the Treasury market as a function of the geopolitical dynamics we tend to see in fourth turnings.
Yeah,
you always see trade protectionism. Unfortunately, we've always seen total war as well. And so the likelihood that we continue to see reduced international demand for the Treasury bond market at the margins as we go forward in time is a structural dynamic that you should expect. And that's why term premium have been up and to the right. This is 10-year term premium. They've been up and to the right for years. And so it's our view that is likely to persist. And as long as that persists, you're talking about, fair value on the 10-year, at least in terms of our model, is somewhere close to 5.5%.
Mm.
Exactly. And so there is a, there, again, we've been saying this for 2 years now. There is a geopolitically driven supply and demand imbalance in the treasury bond market. And we're now starting to see real direct manifestations of that. You look at what's happening in Europe with NATO taking up their defense spending. That's a capital call home from our largest creditor. I think Eurozone owns about, in aggregate, about 8% of the marketable treasury market. And so that's a capital call home for Europe. If you look at Japan, they're normalizing policy. They've escaped a deflation and have been persistently above trend and above target on inflation for the last 3 to 4 years. So that's the structurally elevated inflation is another dynamic that you tend to see in forward turnings as increased trade protectionism, increases the price of goods and services around the world. Japan's certainly, experiencing that right now. So that's another, sort of capital call, if you will, away from the treasury bond market from one of our largest creditors, our second largest creditor. And then our third largest creditor, China. Both the US and China are in this messy divorce called strategic decoupling. And so that's less demand at the margins to capitalize the treasury bond market from the perspective of Chinese investors and the Chinese reserve managers. So, our three largest sources of foreign capital are moving away from the treasury market, not towards us. And that's why term premia have been rising for years now. In our opinion, that's only going to deepen as we go forward in time because our deficit situation continues to compound on itself. It may look, in the advent of the tariff regime, it's going to look like we're narrowing the budget deficit over the next couple of years, but it's going to start to blow out again because all the reasons why the budget deficit is blowing out are not being even talked about in Congress. When you think about our friend Luke Groman's from Forest for the Trees, he's got this tremendous expense metric that's Medicare, Social Security, national events, and net interest. That's about almost 2/3 of the budget, and it's compounding at almost double digits. Actually, no, it's compounding at 11% on the trailing 3-year CAGR basis. That just keeps growing and growing double digits every year. So we're going to get a bunch of tariff revenues. It shrinks the budget deficit, but eventually, because that thing keeps compounding, 2/3 of the budget keeps compounding, 10 plus percent every year. Eventually, we're going to start to deteriorate on the deficit dynamics again. Let's call it in 2 to 3 years. And as a function of that deterioration, we're deteriorating from a supply perspective in terms of incremental treasury supply. At the same time, our foreign creditors are pulling away to either support their own bond markets or just because they no longer want to engage with us the way that they used to. So this is a big problem for the bond market.
Yeah,
it's phenomenal. It's fantastic if you're long stocks, gold, and Bitcoin, which is what KISS is, because the only solution to this massive fourth turning size problem is the Fed's balance sheet.
So talk to explain what KISS is and why you don't have bonds in there. So that's one of my questions that to me, that indicates that you think bonds are uninvestable right now or unattractive and don't have a place in a portfolio because of what's coming down the line. So what is generally the KISS portfolio?
Yeah, 100%. KISS is 60-30-10 stocks, gold, Bitcoin. 60-30-10 stocks, gold, Bitcoin. And essentially what it's trying to do is take the 40% of your portfolio that you would otherwise be allocating to a very clearly and obvious melting ice cube and allocate it to assets that are going to benefit in price as a function of a solution to the problem that is the very obvious melting ice cube. And so that's what KISS is. And so KISS is designed to expose investor portfolios to the assets that benefit from the destruction of the bond market that you very likely to see in a fourth turning. I mean, our friend Luke Groman has a great phrase for this. What do they call them? Treasury certificates of compensation.
Yeah.
You're going to get your money back on a nominal basis. Uncle Sam's not going to default, but it will default on a real basis because we don't have a choice. When your debt dynamics get to this stretched and your budget deficit dynamics are just kind of just they're as bad as they're ever going. I mean, they're terrible and they're going to continue to get worse. We're going to lose all the money from Social Security and within a decade. I mean, you think the talk about debt and deficit dynamics is bad now, it's going to be way worse in 5 to 10 years. And so that's the point we're making, is that bonds are, in our opinion, uninvestable. And so because bonds are uninvestable, let's take that money that most investors would otherwise have in their portfolio allocated to bonds and put it to more productive assets. And so in our opinion, based on our careful back testing, which we have on the screen now, based on our back testing, we figured out that gold and Bitcoin are the two best assets to benefit from this. Both our back testing and our fundamental research are the two best assets to benefit from that. And so that's what KISS is. It's just a 3 ETF solution that tells you to be long stocks, gold, and Bitcoin, and it dials up and dials down its exposure to those 3 assets it's either fully invested or it starts raising cash because there's a problem in the markets that
right. And you'll wait for a better time and a better price point to sort of reinvest that cash. Justin asking, hi Justin, asking, hey Darius, what would it take for KISS to shift from bullish on paradigm C to bearish, hypothetically?
100%. Great question. So that means our market regime nowcasting process has to take us out of a risk on market regime or into a risk off market regime. That's the top down risk management overlay in KISS. So KISS is essentially the net result of two overlays, the same type of overlays that you would see at a Citadel or Millennium or Point 72. We're essentially saying we're taking that concept and those types of those proven quantitative techniques, and we're applying that to 3 asset classes. And so the top down overlay says, what style of market regime are we in, based on according to our market regime nowcasting tools. We've been in a risk on market regime since May 13th. And it's our view that based on paradigm C, we can be in a risk on market regime for another several quarters. I'm not saying we will be, but I'm just the probability is reasonably high with that. So that's the top down risk management overlay. The bottom up risk management overlay adds the dynamic position sizing element to that, so that if either one of these assets is breaking down or breaking out before the market regime pivots, then it will dynamic position. The position sizing according to that particular asset will change. So you're essentially getting risk management applied to the portfolio from a top down and bottom up risk management perspective, which is exactly, again, is what these multi-manager platform hedge funds are doing, which many of them are our clients.
Yeah. And I think in this environment, what you have to do, Adam's saying, so let's talk about the Bitcoin component, because we've seen really big gains. And this is a market that tends to, we just had a great conversation with Peter Brandt, if anybody looked at it yesterday, who's charted Bitcoin and like really dove into this because he's been 50 years in the market, really intrigued by this asset. And he was showing us that it goes on these, forms a floor and then has this rise, and then forms a floor and has this rise. And it's kind of getting into this sort of channel. That'd be really interesting to see what happens. So Adam's saying, I wouldn't be long Bitcoin here. How are you thinking about the price action around Bitcoin? What do you look for to try to figure out how you want to react dynamically to that?
Yeah, it's like I said, I just use Bitcoin as an example, pulling up this chart. So this chart shows our volatility adjusted momentum signal, which KISS uses to manage the bottom up risk management overlay. As long as Bitcoin is bullish, it's going to want to be long Bitcoin, and so that's step one. So if neither the volatility of the asset class nor the momentum of the asset class is telling me to agree with what was
it was Adam.
With that, telling me to agree with Adam. Now, eventually, if Adam is correct, then our BAM signal will pick that up in short order. But based on our fundamental research views, which have no bearing on KISS, they just help me and our clients anticipate how KISS and Dr. Mo are going to evolve in the future. Based on our fundamental research views, I don't know that I agree with that call. I would expect Bitcoin to remain bullish at the bare minimum, maybe transition to neutral. Highly unlikely we get to a bearish signal in Bitcoin or stocks at any point in time over the next few quarters, because again, we priced out a lot of the left tail risk from a positioning cycle perspective, and there's a tremendous amount of right tail risk that we need to price in. So that's the bottom up risk management overlay.
I see ETH on there too. So when you're sort of saying stocks, gold, Bitcoin, are you scooping ETH into that, or is it sort of just Bitcoin?
Yeah, just stocks, gold, Bitcoin, S&P 500, gold, Bitcoin. We can make it more complicated, but the reality is I don't know that we would have many clients if I put 10, 20, 30 ETFs into a quote.
This is interesting. I just had this conversation with somebody else about like staying narrow on your focus so that you can really understand what's happening and maybe not having too many things on your trading, on your
Maggie. If people, this is the most important thing I'm going to say in this entire interview. Stop taking factor risk as a retail investor. You are not getting paid any money at all to do the hardest thing to do in finance, which is to pick factors, long and short. The people that we service manage a collective $25+ trillion. Their job is to pick factors, and it's very hard. And many of them wind up playing whack-a-mole, going from shop to shop, trying to pick factors. You don't have to succumb to that. You're a retail investor. You can just go open up a basket and collect the beta like manna from the heavens. Just get the beta of the return. Just get the beta of the market. You don't need to beat the market as a retail investor. Why? Why are you trying to beat the market? That's what their job is. They're getting paid millions of dollars to do that. You're not getting paid a cent to take on all that additional stress.
Taking on a lot of risk.
And a lot of stress, because you got a bunch of factors moving around your portfolio long and short that you don't have any ability or any systems to risk manage properly. So in my opinion, I think we created KISS to make sure that our clients actually open up their baskets and collect the manna from the heavens and close the baskets when it starts to rain. That's it.
Great advice. And Ralph pointed out, and most fail to beat the market. And that is true, especially right now when we have tons and tons of people coming on saying it's one of the hardest macro environments they've been in. And, we have so much uncertainty, hard to see through the fog. Dr. Dan asks, how much dry powder would you reserve given this wacky economic behavior?
Before I answer Dr. Dan's question, I respectfully but firmly but respectfully disagree with that previous comment. This has been the easiest year of my career from the perspective of calling macro, because it's been
Why is that, Darius? Because we've had a lot of people with a lot of experience come on and say it's been so hard. Why? And I think it's because of the noise of politics. But tell me why you think it's been so easy.
Bingo, because you have to see the world through the lens of the paradigms that we identified. If you put this chart on the screen, we show what it was very clearly one of the most important images I've ever seen in my lifetime. The electoral college map was bright red from C to shining C, which, in my opinion, was one of the most clear signals that the Trump administration got a very clear mandate to come in and change things a lot. Mm-hmm. And so what happens when you need to change things a lot, starting from our fiscal indebtedness situation, there's only really three solutions: cut, grow, print. They tried the cut part with Doge, and they tried to cut the trade, the current account deficit, unilaterally renegotiate trade, and that obviously ended very poorly, and it caused the administration to have to pivot to the growth phase. Both the growth phase and the print phase are very bullish. And so if you think about the world through the lens of our three paradigms, paradigm A is this: what caused everyone to be pissed off enough to vote for, the same thing in every little town all across America. That's paradigm A. We know we're not going back there. So we're either going to cut, grow, print. We tried the cut part. It didn't work. So now we're in the print, grow, and or print phase. And both of those are incredibly bullish. And we recognize that back on April 23rd and have been helping our clients make money ever since.
I think it's something really interesting you said before. And that is, it's ultimately not going to work, but for the next couple of years it can. So this is where time frame really matters, right? And I think some of the people who are looking at what they see as seismic changes in a sort of, multipolar world, the fourth turning, some of the things you're talking about, disruptions. We've had Juliette de Klerk say, the dark soul. By the way, she's in alignment with you on a lot of this stuff too. She has been positive. So not to say that she's one of the people that said it was negative. She also, like you, I think, sees the positive impulses. But there's a lot of disruption coming. So maybe the people who find it really hard are thinking about that in a longer term perspective. Whereas you're saying shorter term, if you focus on what you just talked about, it's a very different story.
If you don't mind, Maggie, I would actually flip it. We're thinking about it from the longest of term perspective. We're in a fourth turning. There are only a few menu. The menu is not very big. Cut, go, print. They tried the cut part, which would have been very painful from the perspective of investors and asset markets, but ultimately would have probably wound up with a better solution for the people on the bottom part of the K and the businesses on the bottom part of the K that have been getting crowded out. We've essentially said, well, sorry, we're actually moving on to the growth part now. And so ultimately, that's a multi-year call. I think we're going to be in paradigm C at least until the midterm elections. And if the midterm elections go favorably for the Republican Party, we will be in paradigm C at least until 2028, until the end of 2028.
Do they have to get it right? Is there a risk? And I think this is where the other maybe hesitation comes up. I think that people think that it's so hard to get this right, and that what seems to be a sort of chaotic Trump administration and warring factions in there, there's a chance they blow it up. You're saying kind of doesn't matter who's there. This is what the voters want. This is what, no matter who is in charge, this is what they're going to have to do.
Well, kind of. I'll amend that slightly by saying there are so many levers for them to pull that they're already pulling that they will get it right for a transitory period of time. Now, transitory could be until the midterm elections. It could be until the general election in November 2028. I don't know how long that's going to be, but it's either 2 or 4 years. And the reality is, you think about all the levers they're pulling right now that are on the tape. The one big ugly bill is front loaded in terms of the peak positive fiscal impulse. Like right now,
absolutely. Everything is later. All of the costs come later.
The cost cuts come later, but the tax relief and the incremental spending comes early. So we're going to get peak positive fiscal impulse over the next couple of years. So that's one. We know we're going to get a loss of erosion of Fed independence that forces through negative real policy rates at some point over the next couple of years. That's number two from a monetary. So you got fiscal monetary tailwinds. How many more tailwinds do you need? I'll keep going, but you have deregulation.
Well, by the way, you just talked about maybe no capital gains on sale of a house. Like you can see they're just throwing everything. I'm not saying that's going to happen, but they're throwing everything at it.
Bingo. So doesn't it look like the administration is panicking to engineer a positive economic outcome? I mean, go to everyone. After you watch this show, go to Scott Besson's Twitter account, my former client, and just read his most recent tweets. It looks like a guy who's desperate to tell the world that we've entered this new growth phase, the economy is about to boom, and you need to stop talking bad about us, media. That's exactly what his whole entire Twitter account looks like, and this is what we've been telling you for the past 3 months. Is there's no other solutions. And so, sorry to go back to
no, I love it.
The levers they're pulling. They put this man Paul Atkins back in charge at the top of the SEC. This is the guy who was the DJ playing the music when Truck Prince said we got to keep dancing back in 07. Right. So we know we're going to get a crap ton of financial sector deregulation. We're very likely to see a private sector credit cycle. And oh, by the way, on top of all this, I don't know if anybody saw the news this morning. President Trump just fleeced one of our biggest trading partners. Just completely fleeced Japan. It took me like 30 minutes to figure out what we actually gave Japan in the deal for them to give us $550 billion of investment and all these other concessions and all these purchases. I was like, man, I didn't even consider that as a possible upside risk to our own incredibly bullish, 100 percentile bullish view across global Wall Street, a paradigm C theme. But what if we fleece a bunch of other people in these and renegotiate global trade in a way that is very net on balance, net favorable for the U.S. economy? So there's so many levers that they can and are already pulling. And so as an investor, going back to the question, to me, I think the more long-term your time horizon, the more bullish you should be, because it's very likely that these levers get pulled, they are being pulled, and it will result in, at bare minimum, a transitory positive shock to growth. But that could be 2 to 4 years.
Amazing stuff. Darius, this has been so fun, and I think really helps explain like why so many people have been underperforming, because there's been a lot of people were convinced that there was going to be policy error and that was going to result in a lot of trouble. And this is a really interesting way to think about it from a different perspective. And I think kind of like a nonpartisan perspective, which I think is really important, since so many
100%.
people get wrapped up in the, their feelings about the current administration.
Yeah, 100%. I mean, obviously, you can't invest with any political bias. I mean, I'm about as data-driven centrist as they come. I don't have a political party that I affiliate with, and certainly don't vote with either party. The one thing I would say, if I can say one thing to investors who may not have participated in as much upside as they would have liked over the past 3 months, one of the things I learned from a great investor, very legendary investor, many of you guys know who it is. I can't say who it is. One of the things I learned a long time ago is that it's never too late to get on the right side of market risk.
Yeah.
Like it's never, today is the best day to align your portfolio with prospective market risk. It doesn't matter if you missed it or not. It's about right sizing your portfolio for what is likely to occur relative to the positioning cycle. Now I'll say positioning cycle is a lot different now than it was when we told people to start buying. It's a lot less, there's a lot less upside from that perspective. But again, as we move forward in time and the general level of policy uncertainty decays, that ultimately means a lot of the slower moving institutional style money, the sovereign wealth funds, the big sleepy mutual funds up in Boston and then out in California, their investment committees will say, okay, things are fine now, and they'll start to put more money to work. And you definitely want to be in line buying before they do. So if you haven't participated, it's not too late, because this paradigm C party will last for multiple years, at least until the midterm elections.
Fantastic stuff. Darius, it was so fun to catch up with you. Always a pleasure. Thank you so much for sharing your knowledge and doing what you do to try to help ordinary people, because everyone needs that. And there for a long time wasn't enough of it. So we so appreciate you.
I so appreciate you, Maggie, and ditto right back at you. I'm a huge fan of yours. I love what you're doing and building here. So obviously I'm a big supporter, and I just wish you all the best.
Thank you so much. And as always, we'll drop all of Darius, and someone just said they resubscribed and your stuff is phenomenal. But we'll drop all of Darius's information in the chat, as we always do. And happy birthday to your son. So fun. I can't believe a year went by so fast, but enjoy the rest of the summer with him.
Okay, thank you, and God bless, Maggie. Appreciate you. Appreciate everybody for tuning in. Thank you so
Yeah,
much.
same here. Appreciate you all. We will see you again. Great conversation with Paolo Macro coming for you on Friday. He had some really interesting things to say, as he always does. So stay tuned for that. And in the meantime, of course, take care and good luck out there.